Hey, everyone. Today we're talking about HELOC changes, upcoming changes to Canadian home equity lines of credit that will affect a lot of people, specifically homeowners, property investors, and those specifically who use their home equity line of credit as a way to shelter them from income taxes with something called the Smith Manoeuvre. And if you're just joining me now, this is Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast. And I'll be talking about these three ways that home equity lines of credit are changing at the end of this year. And these changes actually, they're um, they're changes that mortgage brokers really don't want. They're changes that are not going to be well received by Canadians. And I think it's one way the government is restricting the ability for a lot of homeowners and property investors to access their home equity for purposes like fixing up and keeping their rental property in good repair, or for emergency funds and whatnot. And if you're joining me on TikTok or Instagram, I don't have the numbers up on my screen the same way I have them up on my screen on Facebook or LinkedIn or X. So you can join me on those platforms, and I'm actually sharing the numbers there. But what's changing for home equity lines of credit is I'll try to talk this out with you as well so you guys understand where I'm coming from on this, is that the amount that they're letting folks access on their equity is going to be a lot less than what it is right now. So if I can just expand on that a little further, one of the things that's going to change is when you're applying for a home equity line of credit, usually what happens is you're getting your home appraised. And the home is going to be appraised at an amount that is fair to be sold on the market right now. And with that specifically, your home equity line of credit is able to go up to an amount called the maximum loan to value. And that right now in Canada is 80% loan to value. So that means essentially, if you're joining me on Facebook and Twitter, X, you can see my screen there. But if your home value is $850,000, that's the amount that it appraises at. And say your mortgage that you have on your property right now is at 450,000, which is, very, very possible. It's very possible to have a mortgage around 450,000 on, a home these days. Then the amount that is remaining is up to 80% right now is the amount that we can access as a line of credit. And if you've ever applied for a line of credit, you know that it's really hard to get one. But if you do get one, you can go up to 80% of the value of the home and access that as a home equity line of credit. So one of the things that's changing right now with that is that they're going to change the amount that you can actually access on your home equity line of credit, which is really surprising. It's going to really limit a lot of the activity property investors can do on their homes when they're doing things like repairs, upgrades, or even buying another rental property. So one of the things that's changing, that's going to change at the end of this year, is that the amount that they will allow you to access on your equity through a home equity line of credit is going down from 80% loan to value, which will be the maximum loan to value, to 65% loan to value. And that will be the new maximum loan to value allowed under this program. So quite a substantial difference, as you guys can tell, going from 80% of the value of your rental property or home to 65% is a big difference. So if you have a mortgage of 450,000 on a $850,000 valued home, then your home equity line of credit, what would be available today, providing you qualify, will be $230,000. And then come this fall, it'll be dropped down to $102,500. Quite a substantial change. What do you guys think? Do you guys think that's a good thing that the Canadian government, specifically OFSI, the Office for the Financial Institutions Superintendent, wants to come up with these guidelines that will be released this fall? And these guidelines will essentially be dictating on how the banks and lenders can advance their lines of credit. And as if you're just joining me now, one of those main changes is that they're taking the amount that you can access and taking it from 80% loan to value down to 65% loan to value. So again, if you're a property owner or a property investor that owns a property that's valued at $850,000 today, and you have a mortgage of $450,000, then right now, if you apply for a line of credit right now, you can actually apply for up to $230,000. And as of these changes, you'll only be able to apply for up to $102,500. So big changes there. What do you guys think? Will that affect your plans or your property investment goals? Let me know in the comments. I know that there's been a few property investors I've spoken to over the last few weeks that say this is not a good thing. This is something that's going to really restrict their ability to expand their rental portfolio and keep their rental portfolio in good repair. So it's something to consider. Now, as you can see, there's another aspect of this that's changing here, and that's the fact that not only are we changing the amount of line of credit that is accessible from 80% of the value of the home to 65% of the value of the home, but we're also changing the fact on whether or not the banks can offer this program. It's a readvanceable line of credit, and this is a mortgage and line of credit intertwined all in one. And we've seen a lot of these products come out through lenders like Manulife. They have a whole all-in-one mortgage and line of credit product. Scotiabank has the STEP product, which is the Scotia Total Equity Plan. And I've done that program for a number of clients of mine. And what that program allows you to do is to pay down your mortgage, and every dollar that you pay down your mortgage, actually, it opens up a dollar of available line of credit room. So it allows you to sort of readvance your debt as soon as you've paid it off. And that's all automatic, and that is also coming to an end at the end of 2023. And that's one of the guidelines that the government is coming out through their OFSI institution that governs financial institutions in Canada. So many thanks to Ron Butler for these pieces of info. He's the host of the Angry Mortgage podcast, and it's quite a awesome podcast if you decide to check that one out. Good information there. And one of the things that I got from his podcast is that there's no real reason to be worried about this, and that if you are in the situation where you need to access as much line of credit as you possibly can, then apply for it now. You can actually prepare for this. You know the information now that they're changing these rules, and that if you need to have the ability to access the full $230,000 on your line of credit, to apply for it now and not wait until the fall or next year, because by that point, for sure, next year, this product will not be the same as it is today. And the part that is readvanceable, that's changing as well. And if it's readvanceable right now, what you're going to see is that the line of credit right now, it's increasing for every dollar of principal you're paying off on your mortgage. And what's probably going to happen is you'll receive a letter from your financial institution just letting you know that this feature is no longer a feature. And one thing that I got from Ron's podcast is that, they really can do that. You might think they can't, but it's just a feature of the product that you were approved for that it makes it readvanceable. It's not the product itself that they're changing. It's just a feature of the product they're changing. And that's how they can get away with saying that they can make this change. They're just removing this extra feature now on your home equity line of credit. All right. So we've talked about 2 out of the 3 changes that are happening now for home equity lines of credit. If you're just joining me now, my name is Joe Bladdock, host of Canadian Mortgage Weekly, and we're here on episode 152 talking about 3 changes coming to HELOCs, home equity lines of credit, by the end of 2023. First change is that we're seeing that they're going to limit and restrict the amount of line of credit you can access from 80% of the value of your home down to 65% of the value of your home. And if you're watching me on Facebook or LinkedIn or YouTube or X, you can see that I've put the numbers up above. And what I'll do is I'll explain them for the TikTok and Instagram followers here today. Make sure you hit that plus button and subscribe to get my next week's podcast. Very helpful information. But looking at this one, it's $850,000 typical home value here. Middle class home, $850,000. Mortgage, $450,000. And you're applying for a home equity line of credit. Today, right now, providing your income and credit allows you to qualify, you'd be able to access a line of credit limit of $230,000. And we could set it up as being a readvanceable line of credit. So a pretty fantastic product. It allows you to have an available extra dollar for every dollar you pay off on your principal. So if you pay your principal from $450 to $400, then your line of credit increases from $230 to $280. Now, one of the changes happening at the end of this year, this is a government change that has been advised for the financial institution. It's going to be announced this fall, is that they're changing it so you're only going to be able to access 65% of the value of your home, which will bring the line of credit portion from $230,000 to $102,500. And one of the things that we advise that if you are needing this line of credit, the most maximum amount that you could possibly require is to make sure you get the line of credit set up before the fall and that you get all that rolling. So you can get that line of credit set up for what you need, whether it is fixing up your rental property or portfolio or using it for emergency funds, whatever you need, get it set up. Second thing that's happening is that it's not going to be readvanceable. So if your line of credit does increase where you have that combination product, it's not going to do that anymore. It's going to, you're going to have your line of credit set at where it's at. You won't lose it, so you don't have to worry about it, but it won't any longer increase in the amount of limit available as you pay down the principal of your mortgage. That's going to be a big change. And a lot of people have counted on that extra available room up, and they will have to make alternative arrangements on how to be able to access additional equity. So those of you who do count on that as additional equity, make sure that you talk to your broker or your financial institution about other options for that. So the third thing that is changing, because this is going to be another big one, and this so far is unofficially announced, but we're going to have to wait to see if it's going to be officially announced in the fall, and that is that those who have a line of credit that is up to 80% of the value of their home right now, when it comes to that product being renewed, I'm hearing that any amount between 65% and 80% will be converted into a standalone mortgage. So that means that, say, if you get a home equity line of credit up to 80% and you get a 5-year fixed term, upon renewal of that combination mortgage product, that line of credit that is above 65% but below 80% will be converted into a standalone mortgage, which will mean you can't just pay it off and readvance it and pay it off and readvance it anymore. That portion will be stuck into a fixed loan term of some kind, and then it'll be converted into a standalone mortgage. Now, that may be really hard for a lot of investors because they will be used to paying interest-only payments up until that point for that balance. And all of a sudden, it's being converted into a amortized balance, which will mean that principal and interest payments are due on that balance on that schedule. We'll have to see how that all works out and how they plan on rolling this out, but it's going to cause a lot of cash flowing issues for those that are relying on that line of credit and the interest only payment on it. So these are changes being announced this fall. And again, those changes are the limit as to the max loan to value, whether it's readvanceable, and if you can keep the readvanceable portion above 65% after renewal. And that's all changing. New rules coming out at the end of this year, 2023. And if you have any questions about any of that, make sure you contact your mortgage provider or myself. I'm a broker, been in the business now for 13 years and helped people and homeowners and property investors set up lines of credit, pay off mortgages, all that stuff and in between. I'd be happy to set up a time with you to talk about your financial situation and your goals so we can set up a right mortgage product when it comes for renewal, or if you want to get this line of credit set up and get it going the way you want, we can do that as well. So with that in mind, I know that we've chatted a lot about these changes to the home equity lines of credit, and we'll come back to them a little bit later in the program just to recap. But right now, I would like to continue on and chat about some of the statistics and news that is coming out of the mortgage market today. One of those things here is the interbank rate, and that's actually dropped 0.01% since last week, which probably means nothing. However, in a very sensitive environment where we have seen a lot of hype towards rate increases by the Bank of Canada, the interbank rate decreasing by 0.1% is the smallest indicator we could get, showing that the Bank of Canada has one reason not to increase rates any further, and that's the interbank rate dropping 0.01%, although not a significant of any amount. But if it was going the other way, then there would be a reason to go the other way. 5-year bond yield. Why am I talking about this? The bond yield is what fixed rates in Canada are based off of. So the Bank of Canada's rate announcements impact variable rates, and then the bond yield and the bond market is a separate, completely separate area where fixed rates are determined for Canadian customers of mortgages. Right now, that is sitting at 3.86%, and that 5-year yield has actually dropped about 20 basis points from its high point just last week. So good news all around that when fixed rates did go up last week, we shouldn't see any more hiking of fixed rates, at least for the next week or so. So great news there. And if you're looking for a house right now and you haven't got pre-approved, you probably have at least another week, but don't take this as financial advice. All right, so what's happening with the unemployment rate? Huge news there, up for the third time in a row. Unemployment has gone up 3 months in a row now, which is huge news, especially when we have such immigration happening in Canada. We have huge immigration. We have about 500,000 to 1 million people coming in every year into Canada. And we have all these jobs being created, but also at the same time, unemployment went up for the third month in a row. So unemployment rate now sitting at 5.5%. That is the highest in the last 2 years. And we'll have to see what happens. But in addition to the interbank rate, we have the bond yield. It did go up since the last rate announcement. However, it has not continued to go up. And we have unemployment now up for the third month in a row. That's a reason for the Bank of Canada not to increase rates, although a very, 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 very small reason because the rate change was very small. Canadian inflation, we still don't have the figures for July. Right now, we still have figures for June, which were sitting at 2.8%, and that was a decrease from the 3.4% and 4.4% in April. So far inflation, we don't have the most recent numbers, and I want to see these most recent numbers to be able to advise you all if I think the Bank of Canada will truly raise rates. But what do you guys think? Do you think inflation did go up last month, or did it stay the same, or did it actually go down? I would tend to think that inflation actually probably went down, but just a slight amount. I could see us having an inflation rate of about 2.7% for July, but we'll have to wait and see. United States inflation. So what's happening there? Those numbers for July did come out. They came out higher at 3.2%. So inflation did go down to 3% in June for the United States, down from 4.1% in May, down from 4.9% in April, now sitting at 3.2%. So 3.2% still a lot lower than March, April, May, but higher than June. So this is actually pointing to something right now that could show Canadians that the Bank of Canada may increase rates come September 6th. Is the fact that the Fed is seeing their inflation rate continue to go higher. And we're closely tied to the United States and Canada here. So the US is seeing something. We probably will see that too. So now seeing that, my inflation estimate of 2.7% could be wrong. However, I'm going to stick to my guns there. 2.7% could come higher, 2.9%. And if that happens, rate hike in September is on the table. Average national home price in Canada. If you're looking at this, it did go up for a number of months in Canada. Went up from January until May, but we did see a decrease in the average national home price in June. So 1 month decrease, it's down now to $709,218, and that is a decrease of 3%, a decrease of 3%. So that's quite a big decrease. We'll have to see how this fares out. I know that usually in September we have a increase to the average national house price again as kids go back to school and parents start looking at houses again, and there's a huge higher demand there for real estate. But real estate prices did peak again, and transactions peaked again in May of this year. We'll have to see if we can continue this amount of transactions going into the fall. I'm going to guess that we should see some additional demand maybe September, October, November. All right, so with that, I think I've covered all the things I wanted to cover here on Canadian Mortgage Weekly, specifically on the mortgage side. Fixed rates, as you know, they have been going up. I have been talking about that. Make sure you follow my account, whether or not you're following on Instagram, TikTok, YouTube, LinkedIn, Facebook, X, Twitter. Do follow. Would love to be able to get you this content. I come out with my podcast once a week on Thursdays at 11:30. And this week we're talking about 3 changes to home equity lines of credit. And with home equity lines of credit, let me just recap those changes for you here today. One of those changes is that they're changing the amount of available line of credit that you can apply for this fall. And this is coming down from the OFSI, which governs the financial institutions here in Canada. And what they're saying is that they're decreasing the maximum loan to value that you can apply for on a home from 80% down to 65%. And essentially on an $850,000 home with a existing mortgage of $450,000, that 80% would be $230,000 of a line of credit today versus a $102,500 line of credit after these rules take into effect. So my advice to those folks who have been on the fence about getting a line of credit application started today will actually grandfather you into these old rules and be able to have you access the most available line of credit that you can based on your income. Keep in mind that your income does play a large role, but say if you do qualify for that, you'd be able to get that full 80% today versus only being able to apply for up to 65% come after fall when these changes are announced and go into effect. They haven't been announced yet, but they will be announced by the OFS side later in the season, probably at the start of the fall. And typically, what happens is we have some time then to have these changes take effect. So what will happen is financial institutions will start then changing their rules so they all are on the same page by the time the deadline comes. So a lot of the times what will happen is some financial institutions will come and make that change right away, and some will make the change between the time it's announced and the deadline. And some financial institutions will actually allow you to apply for that product right up until the deadline. So it all depends on the financial institution and the way that they handle their portfolio. So that's the change number one, restricting lines of credit from 80% maximum loan to value to 65% maximum loan to value, essentially chopping off the amount you can access from your equity. You'll still be able to do your mortgage up to 80%, but not the line of credit. So get it started today if you want to access that 80%. Second feature that is going to stop, it's going to end. It's terrible for investors. It's terrible for those who do the Smith Maneuver. And that is the fact that those combination products that have the home equity line of credit with the mortgage, it's all together, they're intertwined. A lot of these products, they are changing. They're going to change, and the feature that's going to stop at the end of this year will be the fact that it's going to be readvanceable, which means that for every dollar of principal you pay off with your mortgage, that there is an additional dollar available on your line of credit. That is going to change. That feature will be no more. Your line of credit will no longer increase as you pay down your mortgage. It'll be a static amount, and you will not be able to change that once it's set where it's at without reapplying again. And that change is going to hurt a lot of investors as well, because that is going to make it so if you are paying down that mortgage, you won't be able to have that additional equity to put in for additional home improvements or home upgrades or rental property improvements or rental property upgrades. So that will be gone. If you're running a cash flow deficit as an investor, you won't have that extra money that you can draw off of if you are running a deficit to fund that deficit. And if you're having a Smith Maneuver program, you won't really be able to take advantage of the readvanceable line of credit anymore the same way. So you'll really have to think about it, talk to your accountant about a new strategy for that. So with that, not much I can say about that other than you won't lose the line of credit room and limit you have available to you when these changes are announced. So again, if you are looking to access the most line of credit possible and grandfather these changes in, I suggest talking to your mortgage professional about getting a line of credit application set up, either to increase your current line of credit or to set up a home equity line of credit so you can get these changes done and get your HELOC set up before and grandfather these changes in. So the third change that's happening, and the most unfavorable change I could see that's going to hurt investors and property investors and their cash flow, will be that once your renewal comes up, they will essentially take whatever line of credit you've had for that last 5 years, if you set it up today, or 10-year fixed rate, 10 years. Once your renewal date comes up, they're going to essentially convert the amount that is over 65% of the value of your home into a standalone mortgage and allow you to only keep up to 65% of your line of credit. And that right now, it is speculated. However, a lot of brokers in my industry are thinking that they are going to come out with that rule as well. So even though you may be able to apply for an 80% HELOC today before the changes come and grandfather them in, you can only grandfather them in for the remaining term of your mortgage. So that'll be either 5 years for a 5-year fixed, or 7-year for a 7-year fixed, or a 10-year for a 10-year fixed. And essentially, all these rules, what they're doing is making it harder to access equity, making it harder for people to borrow money, and making it harder for property investors to essentially have an emergency fund. So it's also going to make it very hard for property investors to buy a second property using their home equity line of credit, because it's going to limit the amount and it's going to make it a lot harder to access that capital, especially if they need to make home improvements or upgrades once they get into the property. Anyway, been chatting for long enough here. I want to appreciate everyone that's been joining me. Please follow my account for updates. If it's either on TikTok or on Instagram, YouTube, Facebook, LinkedIn, or Twitter X. Love to see you again next week on Canadian Mortgage Weekly, Canada's video mortgage weekly news podcast. And we'll come out with a new video every day on this account as well, with small tips and tricks for your mortgage as well as news. And with that, if you need a mortgage broker or mortgage professional in your life, give me a shout. My name is Joe Bladdock. I have 13 years experience financing real estate, and I'd be happy to talk and schedule a time with you to talk about your financial goals and get those worked out. I'm licensed in Ontario and I'm a broker here in Canada for Canadian mortgages. Thanks for watching today, everyone. Thanks for watching Canadian Mortgage Weekly and for your support, helping me out with my channel and my podcast. Make sure you follow